Well, I think that we can probably start. I would like to warmly welcome everyone to what promises to be a very interesting and rich panel discussion today on the fiscal states in Africa. This is a joint event that we are organizing with United Nations University WIDER in Helsinki, and it is co-hosted with the Development Centre of the OECD. We are here a very distinguished set of speakers that my friend Antonio Savoia will introduce later. So I just want to introduce them. And I want to say that my name is Federico Bonaglia. I am the Deputy Director at the OECD Development Centre. And we are here with a very distinguished set of speakers to discuss one issue which is really central for our understanding of how Africa, and we would even say the developing world at large, can confront and overcome many developing challenges, including those that are related to the current pandemic. In particular, the issue that we are going to discuss today is very closely related to the issue of domestic resource mobilization and building effective institutions in states. We know that this is a crucial element for successful development, and it's also something that we analyze very deeply at the Development Centre. As you may know, we have a number of joint products, including our Global Revenue Statistics Initiative and several regional initiatives on Africa. And these initiatives focus on one fundamental narrative that in Africa, the demographic challenge is such that governments need to put in place, together with the private sector, strategies for job creation, but this can only be done through policies that are adequately financed. Therefore, the discussion we're having today is going to be particularly relevant to understand how African countries going forward can strengthen their institution and mobilize greater resources. I would like now to, before giving the floor to Antonio, just share with you some housekeeping rules. We are on a Zoom webinar. We have interpretation, simultaneous interpretation. If you would like to benefit from this interpretation, you probably know it already, but there is a button at the bottom. You can choose the language. And in case you are intervening and speaking in one of the two languages, just make sure that you deactivate the interpretation function. Otherwise, there will be problems for others to listen to you. We also will have a chat box where we'll be very happy to collect questions and comments. And we will, of course, after the speakers, open up the session for questions and for debate. Without further ado, let me give the floor to my friend Antonio for his setting the scenes. Antonio, please.
Okay, thank you, Federico. My name is Antonio Savoia, and I'm mainly based at the University of Manchester Global Development Institute. But I'm also a fellow at the World Institute for Development Economics Research, United Nations University. And we are here today with a few colleagues and friends for this panel event. We have a mix from different disciplines. Apart from Federico and Alexander Pick, our friends and colleagues at the OECD, we have Professor Yuan Ang, political scientist and China expert at the University of Michigan, Dr. Rose Guji, Executive Director of the Kenyan Institute for Public Policy Research and Analysis, Professor Mick Moore, a political economist based at the Institute of Development Studies, Sussex, and last, Professor Kunal Sen, my long-term co-author and director of WIDER and a professor at the University of Manchester Global Development Institute. So we are here today. I want to give you in few minutes a little bit of a context, why we are here today, why we have this panel on the fiscal states in Africa today. This is part of a wider project, a project that I'll share some slides so that this helps me. It's part of a project that we have at the WIDER, and this is you see here the web page of the project. So I want to tell you where the idea comes from and originates within this project, which is partly about doing some academic research, so publishing, researching, and partly like today, creating a dialogue, sharing ideas and thoughts with the wider development community. What are we trying to do with this project? We are trying to fit into a broader agenda on that revisits the role of states and development. This is not the traditional debate on how much states should intervene, what they should do and what they should not do. We are trying in this wider field is trying to look at state effectiveness, when states can get things done. Often you hear the term these days state capacity. That's the wider field where our project on fiscal states fits. And in particular, we see as an ingredient of becoming an effective state, the ability to finance state activities through systematic taxation, through a stream of revenues that comes from a reliable basis, from broad-based taxation. That's at very least what we mean by fiscal states. So you can, of course, include other ways and other sources of financing states, but that's broadly what we mean. Becoming a state that is fiscally developed, it means being able to systematically finance state activities. Now, a lot of research has been on nowadays advanced economies in this area. So how do you become, how do you learn to tax? How do you finance state activities is a lot of what you'll find it's about developing economies, developed economies. But what we know a lot less is how developing economies can become fiscal states. And there is no guarantee. When we started the workshop for this project with other colleagues, one thing we agreed is that there is no guarantee that developing economies should follow the same trajectory as the nowadays advanced economies. So we are trying to understand a little bit more how developing economies can become strong fiscal states. This is now policy relevant, so it's not just the academic debate. SDGs, Sustainable Development Goal 17, and in particular, Target 1 highlights the importance of mobilizing internal revenues. So financing development goals requires now mobilizing in internal revenues. And to give you a little bit of now, to throw some data into the discussion, to give you a little bit more context of what kind of problems we have been looking at. I've just some figures here for you. The first one, this is the share of revenues, the total revenues as a share of GDP, and it comes from the government revenue data set. So some basic taxation data that gives you an initial understanding of how fiscally developed states are. When you look at this aggregation, the first one, by level of economic development, you see that one of the features of becoming a high-income economy is also that you have learned to tax. You tax better. While instead, middle and low-income economies tax less. They have a far smaller share of total revenues. So there seems to be a neat here, clear correlation between the stage of economic development and how able you are to tax. That's one of the facts that we see. How does now comes the African region? How does Sub-Saharan Africa in the next figure here compare with the advanced economies? Here I have the group of OECD economies against Sub-Saharan Africa. The picture looks bleak here because Sub-Saharan Africa over time, the last 20 years, seems to collect approximately half of the share of revenues compared to OECD economies. So these kind of gaps that we see between countries, between different stages of development, gaps in taxation, this is what with the Fiscal States project we are trying to understand. By the way, and I'll show you the last figure, the African region perhaps is not doing so badly, because then when you throw into the picture the rest of regions around the world, you see that actually Sub-Saharan Africa collects the same amount of revenue shares as South Asia, a richer region, and almost the same amount, just a few points less, compared to Latin American region, Latin American and the Caribbean, which is far richer than Sub-Saharan Africa. So we have looked at these kind of figures, and this prompted us to ask a few questions. And that, where does this gap in tax share come from? Is it about the functioning of revenue authorities only? Or is it instead something broader? Is it also about the type of economic, political, historical conditions that different countries or regions have? This was part of what we tried to answer, this kind of broad question, and you will hear more from the speakers. The second broad question is, when you look at this kind of differences in tax share, is what are the developmental consequences? So two broad questions that with the Fiscal States project we try to answer. We don't have the answer to everything, but we've done some research and we have some thoughts on this. And today is the opportunity to create a dialogue, share some of these ideas with you, with the wider community, and learn from each other. I always learn a lot from these events. The project continues. There will be a special issue in an academic journal, the Journal of Institutional Economics, and there will be also, hopefully, when when we have completed this, more on the policy side, so some of the policy implications. Today, it's a first step. I think I've exhausted the minutes assigned for my introduction. So over to Federico again, and I look forward to this discussion. Thank you.
Thank you, Antonio. Thank you for setting the scene and recalling us some very important elements to inform the discussion, which is first that taxation is certainly a very important component of building fiscal states, but is not the only one. Second, that when we look at one of the indicators of tax capacity, which is tax revenues over GDP, we see an average which seems to portray a kind of ranking where high income, middle income, low income fare very differently. But when we look in a more granular way at country experiences, we see that the picture is much more complex than that. And third, and I think that this will lead into the first question to Kunal, that taxation is, of course, part of a contract. I pay taxes because the state gives me back some kind of services. This is part of a kind of social contract. And of course, tax compliance is an indicator that we can measure to assess to what extent, on one end, citizens are willing to pay taxes, something that we can also look in terms of tax morale. But on the other hand, also as an indicator of how effective and how efficient tax administration and tax systems in general, both domestic and international, are in taxing those that should be taxed. And so my question to you, Kunal, is exactly on tax compliance. What are, from the analysis that you and colleagues have been conducting in the framework of this project, what are the main findings about the drivers of tax compliance? What are the prerequisites for governments to be able to induce citizens to comply, but also to what extent can maybe some behavioral elements push citizens to better comply with tax compliance? So on one hand, what are the drivers and prerequisites for greater tax compliance? And on the other hand, what are the measures that can be put in place to foster tax compliance when it is low? Please, Kunal, the floor is yours.
Thanks, Federico. First of all, let me just say that we are delighted in UNU-WIDER to collaborate with OECD Development Centre on this policy panel and on a very important topic. Both OECD Development Centre and UNU-WIDER have a very shared agenda on understanding domestic resource mobilization, especially in Africa, and finding policy solutions. So it's really great that we can work together on this policy panel. To your questions, what are the three political requisites for tax compliance, and how can we foster the things we need, the conditions we need for tax compliance or for developing a fiscal state? The first, I would say the first political requisite we need is the developing institutions that can provide checks and balances on executive power. In our research as part of the wider Fiscal States project, this is work that I'm doing, Antonio Salvo and Abraham Stagem, who's based in UNU-WIDER, we find that such checks and balances can positively affect the ability of governments to increase tax revenues. And by doing so, checks and balances on the executive increase the pressures on governments to become accountable to their citizens, leading to higher tax compliance. So it's a kind of a two-way relationship, which is very important to understand. Now, what are the examples of executive constraints on the executive power, on checks and balances on executive power? Well, this could be constitutional constraints on executive power themselves, separation of powers between legislatures and executive, electoral rules, independent judiciary, very important, free media, and other accountability mechanisms for state leadership. So this could be a variety of different checks and balances, and obviously take different shapes and forms depending on the country in question, the political institutions there, and so on and so forth. So these are really a wide variety of checks and balances, and one should not assume that this not necessarily means democracy. It doesn't. Now, just as an example of how this can happen, so imagine an effective parliament. An effective parliament can regularly oversee the state's budget, including authority over taxation, the right to audit previous government spending, the right to veto new expenditures, and so on. And you can see clearly the causal mechanism why checks and balances on the executive can increase tax revenues and also make governments accountable, thereby increasing tax compliance. So that's fairly clear in this example why it's important. The second political prerequisite for tax compliance is, as you mentioned, a fiscal contract with the state and citizens. This involves an exchange of tax revenues for goods and services that are valued by citizens. And examples could be universal healthcare, primary, high quality education that's accessible to everyone, could be, again, many other examples where you can imagine citizens value this and they're willing to pay taxes to obtain these public goods. And this is a two-way relationship between the state and the citizen. Now, this is particularly important if the government wants to raise revenue from broad-based taxes, such as income taxes, rather than narrow-based taxes. The fiscal contract really comes into effect when we're talking about broad-based taxes rather than narrow-based taxes. Now, in the African context, with structural adjustment that has happened since the 1980s, it's very difficult to raise direct taxes because tariffs have been lowered or almost zero in many countries. Therefore, it's even more important for the government to raise revenues from broad-based taxes, such as income tax. And this is why it's even more important, perhaps, in the African context, to have a well-functioning fiscal contract. And that's something definitely is very important, therefore, for tax compliance. The third political prerequisite, in my view, for tax compliance or to develop a fiscal state in Africa is political commitment to invest in state capacity, especially related to tax administration that is seen as impartial as well as effective. Impartial and effective tax administrations, from previous research that I've also done with Antonio, is more likely to increase tax compliance. So it's really important that political leaders invest in state capacity linked to a tax administration that is seen as transparent and effective. And obviously, this is quite challenging in many African countries where there's a lot of reliance on resource taxes. Many African countries we know are resource-rich economies, because resource taxes are very easy to collect when there's a resource windfall, such as a discovery of oil, or for example, when it's a commodity price boom. But we also have found in a recent paper we published, Antonio and myself, in the annual review of resource economics, that there's nothing preordained about this. There's nothing obvious that resource-rich economies will not invest in tax administration or fiscal state capacity. And in fact, we find quite wide variation in investment by resource-rich economies, in particular in tax administration. So I think it's important to keep in mind there's nothing preordained about the fact that it is more difficult to invest in tax administration in a situation when you have resource benefits. Now, on fixes, on how do we actually bring about, how do we bring about these political conditions? Well, there are no quick fixes. That's the first thing, because what we do see are processes that take time, are historically driven, and we've seen this most clearly in the context of Western democracies. So therefore, learning the lessons of what we see in the Western democracies, we should be careful and not expect technical solutions. We need to understand that these things take time. And in fact, the most important thing is political leaders in countries in Africa slowly making the effort to develop accountable political institutions. And finally, just to say that effective, accountable, and transparent institutions is SDG 16. And domestic resource mobilization is essentially part of SDG 17, which shows why these two SDGs, 16 and 17, are so interlinked and need to go hand in hand. Let me stop here. Thanks.
Thank you, Kunal, also for being very to the point and very disciplined in terms of your time. And I'm sure this will give us an opportunity to have a debate afterwards and a second round of questions with all the panelists. Let me now turn to Marina Nistoskaya. I hope that I pronounced correctly your family name, Marina. And you have been investigating into fiscal capacity of sub-Saharan African states. And one of the arguments that you have been making, one of the hypotheses that we have been researching, is about the different dimensions that may affect the development of fiscal capacity. For example, you have been looking at issues such as the enforcement of property rights, the statistical capacity of African institutions, and you have been trying to assess whether there is some kind of correlation or causation between the different dimensions that we mentioned and the development of fiscal capacity. So, if I understand correctly, your idea here, you are putting fiscal capacity as one of the capacity of a state to perform effectively, and that we cannot look at fiscal capacity in isolation without looking and investing into other dimensions. So, if I understand correctly, maybe you will tell me that I didn't understand what you were arguing, but what are, on the basis of your analysis, the three most important dimensions that different set of stakeholders, domestic, for example, policymakers, civil society, advocacy groups, but also external to African states, for example, the donor community. What are the three most important dimensions that they should be focusing on in addition or complementing to efforts to strengthen tax policy and administration? The floor is yours, Marina.
Yes, thank you very much. And yeah, I think your understanding is quite correct. So what we argue in our paper is that we are not so much argue about fiscal capacity, because we can argue, and I already hear a little bit your understanding of what is fiscal capacity, like, for example, that this is relationship between tax income to GDP. I would think that this is tax outcome, and tax capacity is all the things that make this happen, including, for example, the strength of tax administration. But I also think that in the core, that is the interpretation of our argument is correct. We argue that strengthening only capacities of the state that go directly to extracting taxes, so to say, is not enough. And interestingly enough, our starting point, I think it's important to understand our starting point is very close to assumption that Kunal was saying, and this is the argument is we anchor our argument in the theory of fiscal contract theory. And the fiscal contract theory basically, in a nutshell, that it underscores that the preference for the public goods provision is the reason why people begin paying taxes. They cannot achieve public goods individually. That is why they provide an entity, the state, with some of their contributions, and this entity provides them with the public goods. And public goods, it can be peace or freedom from external invasion, internal order. In concrete examples, one of the first historical public good provision was corn storages by the state. But what we are also thinking that this picture is incomplete because there is state also can provide assumption individuals with some private good, not public good, but private good. Assumption what states do and should routinely do, which is not necessarily related with the tax revenue, can help to improve this, if you wish, willingness to pay taxes. And what we specifically talking about is anything that relates to the activities of the state that relate to the regulation of property rights. And we are not first here. Beshley and Persson call this legal capacity. So basically the argument that for the if the state provides the if the help of course the end product of the highest aim of any state activity with regard to regulation of property rights is secure property rights. But we need to begin somewhere, and the beginning of this process is a good regulation of the assignment of the property rights, describing property rights, or formalization of property rights. This is the very beginning. And when the formalization of property rights would provide individuals with a meaningful opportunity to improve their economic standing. So, for example, instead of sending a family member or an employee to guard the borders of their land asset, I don't know, an economic agent can channel this activity, this energy, this labor into something more productive, and then improve that will improve his or her position, economic position. So that is what we call private good, this incentive to this clear opportunity to improve one's economic standing. And I think in exchange for this, individuals will be more likely, they will be, first of all, they will be in a more direct contact with the state, and then they will be more likely to assent to paying taxes. So the question is, what are those critical elements of this legal infrastructure that should be developed in addition to fiscal capacities? So, and we spent a lot of time, myself and my research, my colleague Michelle Darcy, that my co-author, on studying cadastral records. And cadastral records is the documents that are related to the registration of boundaries of land assets, so through cadastral survey. And this is the first thing that should be done. It should be complete, the surveying of land boundaries, the description of land boundaries, their properties, their size, their features. And the second thing, this is not a bet. The land surveying is happening, and it's happening in many South African countries, or sub-Saharan countries. It is happening. What is not happening, and this is crucial and important, that there is this cadastral records, description of land boundaries, and there is this land register. This is like who has what kind of interests in land. These two registers, these two types of documents, state documents, are not linked. And what we explicitly paying attention in this paper is that there should be the cadastral records, the descriptions of land assets, their boundaries, size, and features should be linked with registers, which are records of interest in lands, where lands are ownership, user rights, obligations, and etc. So we need to match people with assets. And this is what we call formalization of property rights. These are two things. So to complete cadastral survey, link these two documents into one record, and maybe also where they exist to digitalize them, so to accelerate this process. And this will be a significant step forward in internal revenue mobilization, in taxing individuals through income tax, to bring in individuals from informal sector to more formal sector, to assumption that hasn't happened so far in many of the sub-Saharan countries. Thank you.
Well, no, thank you, Marina, also for providing a very concrete example from the question of land in sub-Saharan Africa that remains one of the probably major constraints also to broaden the type of taxation, because as Antonio charts depicted, if there is indeed a correlation between the level of taxation over GDP, and if we resort to income taxation, low level of income may explain also why you have low level of tax revenues, and therefore taxing other assets, including land and property, remains a challenge. And so the point that you're making seems to me particularly relevant also in terms of the narrower definition of fiscal capacity, which is, and not only the tax outcomes, but also the tax revenue over GDP. This allows me to move to Mick Moore and to bring him into the conversation from also an historical perspective, because Mick has been analyzing a long series of historical data, and this analysis has allowed him to look at varieties of fiscal states. We heard from the very beginning that there is no single trajectory, that there are different types of fiscal states, and that we do not necessarily need to replicate or emulate what other countries have done in the past in terms of developing their fiscal states. So, Mick, in terms of the analysis that you have done on the variety of fiscal states, what could you tell us in terms of what are these varieties across Africa in the first place? And second, are there specific priorities for governments that are aiming at increasing the narrow definition of fiscal capacity, meaning tax to GDP? What do you want to share with us, Mick, please?
Okay, thank you, Federico. Let me start by saying that I normally use the term fiscal states in what I think is the conventional sense, which is a state which has such an effective and robust system for raising revenue that it can go to private capital markets and borrow large amounts of money fairly reliably at reasonable rates of interest. And before COVID, it was quite marked that quite a number of African states who were not borrowing on commercial markets 10 years before were beginning to do that. So we had a very positive efflorescence of fiscal states in that sense, but it's not yet clear how COVID is going to affect that. On the slightly broader perspective, one point made, and Kunal has already made this, but let me extend it historically. Compared to other poor regions of the world, sub-Saharan African tax collectors do not perform badly. In some respects, they actually perform quite well. And this has quite a deep history. It is not a recent invention. Governments of sub-Saharan Africa, both colonial and post-colonial, have been collecting quite a lot of revenue for quite a long time. So there's nothing kind of new about tax collection in Africa. But the average picture is fairly positive. The range is absolutely enormous. We have revenue systems like Kenya, South Africa in particular, which look extremely modern in one sense of the term. You know, they would not be, they'd be quite at home in Europe. They look very similar, they do similar things. And then we have at the other end, a number of governments that actually rule, but they collect very little revenue. We don't know how much they collect, but I've seen, if you take, for example, the states of Nigeria, DRC, Democratic Republic of Congo, and Somaliland, I've seen the figures, 7% of GDP as recent estimates how much tax revenue they raise. So we have an enormous range, and the systems also vary enormously from the relatively modern and sophisticated and digitalized to something which is far back beyond that. Now, in terms of what to do about this, I mean, the first point to make, and again, I'll underline what Kunal said, as far as we can tell from very poor statistics, the ratio of tax to GDP in sub-Saharan Africa on average is not increasing. It is pretty much stable. And the statistics are so poor that we might eventually find that's not quite true. But so while we've got a fairly good history, the current trajectory is actually not particularly encouraging. Why is that? And what can be done about it? Well, different people approach this in different ways, and I don't think there's only one way to approach it. Some people will say, look, it's all politics. And it obviously is very political because governments are trying to take money away from people, and that certainly gets people quite exercised and quite organized. So it's certainly very political, and we'd be very unwise if we were to talk about increasing revenue without recognizing the central political nature of it. But having said that, many people have tried to work out what is the key to effective tax reform? What are the politics of effective tax reform? And so far, in my reading of what I've come up, we have a whole lot of generalizations that are on the whole pretty obvious. You know, you need good political leadership, yes. You need some good allies. You need to understand the technology, you know, the technical side of what you're doing. You need excellent PR to try and sell this to the public, etc. All true, but on the whole, not enormously insightful over tax. So that, you know, that's a political view. Some people say, no, the problem's really more centrally tax administration, and we need to improve that. That is not actually such a different position from the first one as it sounds, because I think, again, there's a pretty good rule of thumb that if governments want a more effective tax administration, they can create one. It's up to them. It's their decision to give the resources and, more importantly, to give tax administrations political cover so they can do their jobs. So if you have a bad tax administration, in some degree, you'll say, actually, the government really doesn't give this priority. So the two are not completely separate. Or again, you could look at this from a much more technical point of view and say, well, what are the kind of big tax gaps? You know, where can we collect the money where it's not collected? I mean, these are variable for many countries, but with colleagues, I have identified, well, let's say 6, which I think are fairly high priority for most African governments, and I'll just run through them very quickly. The first one is the tax avoidance by transnational corporations, by profit shifting, etc., which you at OECD know a great deal about, and which on the whole you've given priority to in the past, which remains a very problematic area. We could talk a bit about what to do about that, but there are no easy solutions. I would just say on that when we talk about tax compliance in Africa, the tax compliance problem is dominantly a problem of companies, not of individuals, or if it's of individuals, it's of rich people, not poor people. And the one thing that is often said about tax in Africa that is just wrong is that somehow, if we could find a way of taxing the so-called informal sector, that would solve the tax problem. I mean, we don't know what people mean by the informal sector. It's a word people use because other people use it. But many people, when they talk about the informal sector, they basically mean, very small scale operations and poor people. And, if you want to raise more revenue in Africa and you focus on that sector, you are on a hiding to nothing for reasons that I could explain later. So briefly, so companies. Secondly, and specifically, we know that Africa depends very heavily for exports on oil, gas, and mineral mining commodities. These are grossly undertaxed, especially mining commodities, for a whole range of reasons. But that's probably the biggest single tax gap, but also one of the most challenging tax gaps. Thirdly, tobacco in particular is undertaxed in Africa, not only partly in terms of its revenue potential, but partly because it is such a poisonous, dangerous thing that does so much harm, and consumption of commercial tobacco is going up in Africa. So more tax of tobacco, and to some extent alcohol, would be good. Fourthly, like most governments in the world, African governments give unjustified tax exemptions to investors. Not all tax exemptions are unjustified, but the unjustified ones are big. So if they could give fewer of those, they'd have more revenue. Value-added tax is now the dominant single source of revenue in Africa. It's been increasing very fast, but perversely, it is collected very inefficiently in Africa relative to potential, more than in any other country. If African governments could collect their VAT more effectively and efficiently, this is really a great source of revenue. As I've implicitly said, taxing rich people through various sources, even basic income tax, is an enormous problem, and it goes way back to independence. It's not a new problem. But wealthy people in Africa do not pay their share of taxes, and the tax systems are not really set up to tax them. And finally, Marina talked about this, property taxation of various kinds. I would say the real priority here is real estate in bigger cities, residential, commercial, industrial property in big cities, which is, again, greatly undertaxed. So the short answer, if we start looking for the gaps, we suddenly feel almost rich in revenue. But, as with all these things, it's all been tried, and no one's yet found the sort of magic bullet for tapping any single one of these sources in a very kind of abundant way.
Well, this was a heroic tour de force of what to do if you want to fill some of the gaps. And you started off from a very operational definition of fiscal state, and also put it into a very clear political context that in the end, politics is what also drives the willingness of doing reforms and improving tax administration. And we are very lucky because the next speaker, Rose Ngugi, has done extensive work on the country that you actually mentioned first, Kenya, and that is for many reasons considered as quote unquote a modern tax system. So I would like to ask to Rose to what extent the experience that she has observed in Kenya, but also in other parts of Africa, in terms of reforming national revenue authorities and modernizing national revenue authorities has been a driving force for the development of fiscal states in the continent. And looking at these experiences, maybe Rose, you can also share with us some lessons learned or takeaways in terms of what could domestic and international actors do to support positive reform and modernization. Rose, the floor is yours.
Thank you very much, Federico. It's nice to be in this forum. I'm learning a lot, and I have maybe something also to give. Maybe I'll give more questions than answers, maybe put more problems than respond to too much, because I understand this is a project that is ongoing, and probably my assumption is that as they get issues that we are raising, then they'll be able to really finalize the project and give us a very concrete directions on several things. So when I got this question, the first thing I asked myself is, what has been happening as far as the trends in tax revenue is concerned, and how would one even relate it from the one angle of discussing the capacity in relationship to the GDP. And I had a small slide, but I think there's a problem with it, so I can just discuss. And what I found from data from IMF is that there seemed to be, over time, since 2004, a decline on the ratio of government revenue to GDP, and at the same time, a kind of a slowing growth over time. So we have a slowing growth, and you also have a government revenue over GDP is also coming down. And to me, this is a key issue that one needs to think of, whether the revenue is not growing because GDP is actually not growing. And therefore, where is it that one would be looking for additional capacity for really taxation? And then when you look at it also, you notice that there is a tendency for the GDP, for the government expenditure over GDP, again, to, it's rising a little bit. It shows that it's rising. And then that raises the question, what is happening as far as the government and the financing of the same is concerned? What is this that is giving governments in the region opportunities to really go out and finance these expenditures? Next slide. So so that's the first question I'm trying to put across. The second one I'm looking at is what has been happening. And there's one presenter, I think it's Kunal, who has brought it, is that since times of the Strategy Adjustment Program, we've seen several of African countries really coming up with these national, and I want to underline the word national revenue authorities. Whether you're talking about Angola, you're talking about Botswana, you're talking about Nigeria, you're talking about Mauritius, Kenya, and the like. This has been happening. But as this is happening, I give the example of Kenya. So you are bringing together various departments that are looking at domestic revenue, say corporate tax, you're looking at customs duty, excise tax, sales tax, and the like. You're bringing them together. But then when you look at a devolved system of government, you start seeing, asking yourself, what scope should a national revenue authority take? In Kenya, you notice that the revenue, on-source revenue for counties is just about maybe 4% of their total revenue, very, very small. One element that is brought out is that from the constitutional point of view, they are only there to collect about 2 taxes, the one that is on entertainment, on the property, but the rest of the revenue should come from fees that are being paid and the like. But they're not able actually to bring all that together. So recently, for example, Nairobi County has approached the KRA to facilitate them in collecting even the revenue collection. We are waiting to see what will come out of it, but there seems to be good news that the fact that National Revenue Authority has capacity, has technology, has staffing, maybe could help county governments really energize themselves as far as own source revenue is concerned. But then what do? Do you then change the law so that you now widen the scope that the national revenue authorities should tap into, not just the taxes, but also other revenues that that need to be mobilized. So that's the first thing I'm trying to bring in. The second thing that you've seen, and I think it has been brought up again, is the issue of micro and small enterprises. And for me, being informal is one element, but the fact that many of them tend to trade among themselves means that to a large extent, there is no opportunity actually to get to the taxation point. In addition, they tend to be localized in the sense that they are not trading, they are not even exporting. And then tapping into them again becomes an issue. But some of them that tend to trade with the large firms, what you'll notice is that they must demonstrate that they have a PIN number, they must demonstrate they have a VAT element and the like, which means that they are able actually to be formalized, if I need to use that word, into the process. So the other thing is that they employ over 80% of the jobs that are created. In as much as they put 20% in the GDP, but they are employing 80%, it means that there could be actually an element of income tax that we are not able to deal with. But their nature of even not clear physical addresses makes it very difficult for one to tap into them. And then the other element, which is also growing, is this issue of regional integration. Take, for example, the Africa free trade area that is coming up. And one of the things that KRA, for example, is worried about is when you go to the negotiations table and you are negotiating on the tariffs, which one to come down and for what products, they are worried if that happens and they are not in the table, it means that there could be implications on the revenues that you get from import tariffs, yet they may not have an alternative of where to get that revenue from local production. And then when one looks at the national authorities, on the other hand, they themselves and how they're operating, then you notice that, yes, they have moved in with the technology. They are trying to ease the filing. They are trying to, check on how to detect inconsistencies and the like. But we are still at the very beginning. We are still not yet there. And probably when these things are done, it may also ease the aspect of disputes that come up, and going to court actually eats into the revenue element and time element. Yeah. So yes, they are moving with the technology, but they are yet to get there, and it's also very expensive to talk about it. On the expanding, go to the next slide. On to expanding the tax base. When you try to think about, so what do you do? I'm happy that one of the presenters has said there is need for harmonization as far as the property rights for you even to tap into property tax is concerned. It's an issue that, for example, even our government is dealing with. And I think there is something to learn, and probably will come out from this research on how then do you really ensure that there is that harmonization of people and property and be able to tap into that. The other element I'm thinking about is what is the scope of tax policy and tax administration reforms? We've been having these reforms over and over and all the time, over and over. So what is it that we have not done as much? And recently, what, for example, Kenya has done is to say, by the way, we've been doing our tax element, but we don't have a tax policy. So they're now trying to put together a tax policy, which would guide in terms of how you define that action that the government is taking up. Yes, we have been having laws, whatever is defining income tax and the like, but the policy itself is the time that is being put together. And probably that will define then what is the scope that one is looking at as far as the reforms are concerned. And then finally, is the aspect of institutional strengthening. One of the key things that KIPRA and KRA has been talking about is given that the tax targets are given by the National Treasury, is it realistic? Because each time they are not meeting the target. So who is not really bringing out very clearly what should be the target? And then you find that, yes, the capacity itself, even to do forecasting, to see the potential for tax revenue itself is also a bit weak. So I know, like now we are working with them to come up with a clear framework that they would put to the table when they are talking with the National Treasury and say, we can mobilize 1 billion probably, but not 1.5 billion. But at the moment, they actually don't have anything that they can put to the table and talk about. And then the other thing that I have talked about is that informal sector tends to be everywhere, no clear address and the like. At the moment, there is an aspect of what I would call supportive structures, whereby there is an attempt to do national addressing system, such that even when you have something like the COVID, it was very difficult to support the MSCs because you don't even know where to get them. And it's the same thing like now that if you wanted them to target them, where actually do you target them? Because they are very fluid. They can move from one point to the other. I think I want to stop there at the moment. Yeah, thank you. Yeah.
Thank you, Rose, for a very rich and interesting presentation that I think complements very nicely what we've heard before. I've been a bad timekeeper, so apologies for that, but the issues that you were presenting were so interesting that I felt that I shouldn't interrupt. But I would like now to move to Yuan Ang, who has been investigating question of institution building with a specific focus on the People's Republic of China. And Yuan has put forward some very interesting ideas, I find. And maybe some of those ideas can be relevant for the debate that we're having now on Sub-Saharan Africa. Experimentation, institutional experimentation, different types of accountability from what we from the Western world could consider to be accountability, different types of corruption, and not having necessarily the same impact on growth and the state formation. So, building on your very rich analysis of the China development experience, Yuan, what kind of suggestions, what kind of lessons learned could you share with us that could be relevant for the debate that we're having now on Sub-Saharan African fiscal states? Please.
Well, thank you very much for having me. It's a real pleasure to join this panel. I am going to highlight a few findings from my paper, which is titled Taxless Fiscal States. And I know that sounds paradoxical, but in fact, taxless forms of finance have historically always been a precursor to modern fiscal states. So first of all, let me emphasize that the fiscal history in contemporary China is actually not unique to China. And you can find striking parallels in 17th and 18th century England and in 19th century United States. It's just that this history has been obscured by the conventional wisdom, arguing that democracy and limits on power in Europe led to capitalist success. Right? So let me just briefly summarize the conventional wisdom. The favorite case in point is the Glorious Revolution of 1688 in England, which has been cited in seminar literature. And the story is roughly that in European economies, there was a process of political centralization, and then democratic institutions were introduced. It led to secure property rights and subsequently the Industrial Revolution and fiscal capacity. So this is the conventional wisdom about how the West rose and became modern fiscal states. However, if you look at the literature by historians have actually abundantly criticized this conventional narrative. And one essay that I would highly recommend is by Professor Hodgson. It is called 1688 and All That. I won't go through all of it because his critique is detailed and comprehensive, but I'll just highlight two important points. So he makes the point that the Glorious Revolution did change the balance of power between Parliament and Crown, but the effect was not what we normally think. It actually led to a government that was more polarized and even more unstable than before. He also emphasized that the issue in England was not that property rights were not secure enough, but that they were too secure. So land in England was not tradable because of the feudal system. So his argument is that the rise of British capitalism was actually contingent on land reforms, on breaking up the feudal system so that land can be transacted and can be used as a collateral for borrowing. Now, why is that relevant to China? Because almost everything that Professor Hodgson describes in British capitalism in the 17th and 18th century is what we see in 21st century China. And they are very similar. One of the commonalities that cuts across the three cases that I examined is that all of these capitalist economies relied on taxless finance, i.e. financing public infrastructure through means other than taxation, especially at early stages of development. The term taxless finance was first coined by John Wallace in his study of US history. It is not the same as the IMF's definition of non-tax revenue, which includes items such as fees, levies, and rental income. Taxless finance is simply a residual category, anything other than taxes that includes debt, land proceeds, collateralization of land, and monetization of state power. For example, using land grants to finance public projects and giving out corporate charters, which are basically monopoly rights to operate in lucrative businesses. These are the common set of tools that were employed in China, England, and the US. So if we now turn into the details of the Chinese case, we'll find that China's experience of taxless finance actually mirrors the Western experience. Taxless finance in China took off after 1994. A little bit of background is that in the period from 1978, which is when market reform began, to 1993, China practiced a system known as fiscal contracting. And you can think of that as tax farming, except the tax farmers were not private actors, but rather subnational governments. Tax farming created powerful incentives for local governments to engage in industrial promotion, but it also led to the central government losing a lot of revenue to local authorities. So in 1994, China introduced a tax sharing reform that effectively centralized tax revenue. So the balance, the ratio of taxes between central and local governments drastically changed after 1994. Now, because local governments suddenly lost a lot of tax revenue, the central and local authorities struck what is known as a grand bargain. And this is a term coined by political scientist Jean Oy. The central government, as part of this grand bargain, allowed local governments to sell land and keep most of the proceeds. So it was from that point onward that we begin to see this phenomenal surge of land sales in China, where local governments leased out land for limited periods of time 50 to 70 years, for example, for large amounts of money to developers and companies, and land sales eventually became actually the majority of local revenue. This was then accompanied by growing local government debt, because local governments then used the land as collateral to borrow more. So the combination of land sales and credit allowed China to finance an infrastructure boom in the 2000s. So the impressive infrastructure that we see in China today is actually not an early product. It's actually fairly recent and only began in the 2000s as a result of this financial revolution. But this financial innovation came with serious problems and costs, as it did in the case of the United States in the 19th century. And the downsides of this process in China today are mounting financial risk, which we see today manifesting in the Evergrande crisis. It's an expression of excessive risk-taking and excessive debt, both in the public and private sector. Okay? And again, not a unique history. We can find parallels in the last century in the United States and even earlier on in England. So I'd like to end with two policy takeaways for the audience and for those who work on development and fiscal state building in Africa. So the first lesson I'd like to offer is that we must take history seriously. By that, I mean we must critically question and revisit accepted narratives about how European economies became modern. If Chinese, English, and American history is any guide, alternative financing mechanisms are not only feasible in Africa, but they're also necessary. Now, this doesn't mean that taxation isn't important. Obviously, taxation is necessary for funding current expenditure. For example, paying public salaries, operating schools and hospitals. But we should keep in mind that large infrastructure and capitalist takeoff is largely dependent on land and credit. So these elements cannot be ignored when we are trying to understand the development process and fiscal capacity building. Now, the second takeaway I'd like to offer everyone is that we should take a portfolio mindset when we think about fiscal management. So for example, if we look at the wealth of a person, we don't just look at how much money he has in the bank. Now, that's an important indicator, of course. If you want to buy a house, you do need to make a down payment and you pay it out from your bank account. But we also want to look at what assets this person has, whether these assets can be monetized. We want to look at his credit score. We also want to look at his ability to turn credit into bigger value, which will generate more income that he can put in his bank. Right? So when we think about evaluating a person's wealth, we take a portfolio approach. So similarly, when we evaluate countries and their fiscal capacity, we also must take this portfolio approach. This means that managing land and credit should be considered side by side with taxation. They're all important, but they're very different because they serve different purposes. And land and credit in particular presents a different set of opportunities and risk. So I'm often, for instance, asked to speak on conferences about the Belt and Road Initiative, which is a major and new source of infrastructure finance from China for Africa. But those types of conversations will be completely separate from that of taxation. So we are carrying out important conversations in silos. And I would urge the audience to go beyond the silo and really think from a systems and holistic approach about how different financial resources are all relevant, how they're connected, and how we need to manage them holistically, including in Africa. Thank you.
Well, thank you, Yuan, for a very rich and interesting comparative perspective, both historically and across country experiences. I think that we have had here a very nice set of interventions, and we have about 20, let's say 15, 20 minutes before closing. So I would like to ask my colleague, Alex, are you with us, Alex? Yep, you have been monitoring possible questions from the audience, or you may have yourself some questions to bring to the fore for our panelists. So since we are opening up with here the debate, I don't know if you have any question that you spot from participants, or some observation and question that you want to throw to our panelists.
Thank you very much, Federico, and thank you very much to the panelists. That was wonderful. There's one question that has come in through the Q&A function that Mick has already spotted and would like to respond to. And it's about there's been a lot of statistics quoted in during this panel discussion, but there's the quality of tax data emerging and other statistics as well from different African countries isn't always as good as from other regions. And so Mick would just like to respond to what that means for the analysis presented in this discussion. So Mick, can I hand the floor to you?
Wasn't sure I volunteered to answer that, but if I did, Alexander, I can. Okay, I mean, I absolutely agree with the questioner. But I'm not sure many of us here actually disagree that much. I mean, we know that the tax to GDP, and much has been written about this, the problems of the tax to GDP ratio, and particularly because GDP figures are not very good and occasionally get revalued. I mean, those problems are gradually declining over time, and the quality of tax data is gradually increasing over time, in fact, quite markedly. So, yeah, I don't think that the suggestion is particularly contentious, and provided we don't try and take those tax to GDP figures as, somehow absolutely true. And I think I mentioned that when I said it's actually hard to tell the trajectory of tax collection in Africa, because the figures are so uncertain that you cannot really do robust statistical analysis that will give you a very clear trend. Let me just add that my own paper was actually based on a different set of historical tax statistics on Africa collected by Lund University in Sweden, which are actually very interesting. And essentially what they do is collect data on how much money governments collect and what is the prevailing wage rate in rural areas for unskilled labor, and can calculate for 100 years how much revenue governments are raising, measured in terms of how many days of unskilled labor in their economies they can purchase. And again, there are a lot of problems, but actually it gives us, from a point of view of the big picture historical story, it gives us a very interesting story, and it's quite an advance, I think, in tax statistics generally.
Thank you, Mick. I will take my privilege as moderator to throw a question to all of you, building on what UNU, but also Marina, from a bit complementary or different perspective, if you want, suggested, which is the importance of broadening the picture and looking, of course, at taxation, but also looking at other assets, non-tax sources of financing, the capacity to borrow, which, as Mick said at the beginning, in the end is the litmus test of whether a fiscal state is in place, whether markets are ready to lend you money, thinking that you will have the capacity to tax and then reimburse. And so on the basis of what UNU said, these two takeaways, in particular, the second one, the need of a portfolio approach and looking at the broader set of assets, at the credit history, if we want to assess properly the capacity of the state, the fiscal capacity, and what Marina also said of the need of looking at a broad set of capacities, rule of law, property rights, statistical capacities, etc., etc. What would you, and I start with the other panels, maybe Kunal and Rose, if she's still connected, but of course then also Antonio, Marina, UNU, what is your takeaway on this? Is the research adequately responding to this need? Are we looking at the broad set of issues? And if it is the case, what kind of recommendation would we have in terms of practical reform agenda? for countries that are struggling to respond to the current crisis, where fiscal capacities are basically destroyed. I don't know, maybe Kunal, would you like to give some thought to this?
I think I'll give the floor to Antonio, perhaps. Antonio, would you like to answer? Because yeah.
Thank you. I mean, it's not the easiest question to answer. These are really big questions, but it's worth trying. I can, I can give initial thoughts based on what we have done in the last year or so, together with colleagues here today in the panel and more widely. So yes, I mean, I guess colleagues working on this project on fiscal states, we all agree that it's not just the revenue authority. So it's not just the contemporaneous factors that make a fiscal state. It's of course important to have a competent revenue authorities. And for example, Mick has written a nice papers for us on Africa, telling us, as he's done today, how important this has been. If I can go back to the figures I showed before, you see there that the picture is not bleak for the African region. So contemporaneous factors like focusing on improving the revenue collection side, the practical side of revenue collection with revenue authorities, that has come up. But it also has come up in the project that the other factors we have discussed here that are deeper, more structural, that is also something important to be aware of. It's political institutions, like Kunal was trying to argue. So the fact that you have political institutions offering checks and balances on the executive. It's the historical conditions, as UN was highlighting. And it's also about taxless forms of finance, not necessarily only the institutionalized taxation. Hopefully that is broad-based. There are other dimensions of being a fiscal state that are important. So the UN has highlighted that and the historical side of it. Marina, similarly, I think was telling us that also the interaction between important functions of the state, so the ability to secure property rights on assets, so that the legal capacity of states then can interact with the ability to raise revenues, so that there are complementarities there. And I could continue and say more on this, but this is just to highlight, to answer your question, Federico, is yes. It's emerging that it's not just the contemporaneous factors explaining fiscal states, and most of the findings we have in the project are papers on Africa. That's why also we have the panel today. So not all the colleagues working on this are here, but it comes to my mind now that Otelge Fajelstad and Merima Ali have a nice paper on the importance of colonial history in sub-Saharan Africa. James Robinson similarly has a paper on Rwanda. So this is emerging. That it's not just what happens in the short term, but it's also about the deeper structural factors. So perhaps, if you want to push it, but it's a stretch at this stage, we should say in policy terms, it's not only what you can do with your revenue authorities. Look also at the structural conditions and what is there in these terms in your economy, because that could explain why the gap in tax revenues is so persistent over time, and there is no sense that the advanced economies are converging with the developing economies. So I can say it's important to be aware of this. At this stage, I think I would push it as far as this, and I'll stop here.
Thank you, Antonio. So I didn't want to caught anyone by surprise, but the argument that were were put forward, but many of you were so interesting that I wanted to push a little bit, and thank you for accepting the challenge. I don't know if anyone else from the panelists would like to chip in very shortly, maybe in 1 minute before we wrap up and conclude. I see UNUN, you would like, please.
Thank you very much, Federico. You always ask the most thought-provoking questions. I wanted to very quickly respond to your question by first emphasizing that taxation, of course, relevant, very important, and we should continue this work. But I want to emphasize first that we need to situate taxation in a big holistic picture of the whole portfolio. And number two, we need to strike the right balance. So if we think about how many papers have we produced on fiscal extraction and compliance, probably thousands or even tens of thousands. By contrast, how often have you heard about taxless finance and the role of land and credit in fiscal capacity building? Virtually never, right? So we have an imbalance in the amount of attention that we are paying to the whole portfolio. If I had a chance to advise, say, a leader in a country in Africa, do you think his priority is extracting, say, $5 from a street vendor? I don't think so. I think his top priority is how will his country mobilize taxless finance to build large infrastructure projects, which in turn will create the centralized formal economy that makes tax extraction conducive, right? So I think that in terms of placing our attention, we need to have the right balance. We need to focus on what is most important to leaders in Africa, and then structure and allocate our attention proportionate to what are the most important things in the whole portfolio. Thank you.
Thank you, UNUN, and I think that this is a very interesting suggestion also for the research agenda, where maybe tax revenues will increase through a process of structural transformation of the economy that may require some push in terms of investment, maybe ignoring, not treating informality as the problem, but as a symptom of the situation. And so looking at increasing tax revenue in a more dynamic way, something that will happen once the economy is transformed. At the same time, as you say, tax reform and taxation remains very important. I think that here I will then conclude by deriving some messages from the various interventions, starting from Mick, because Mick laid out 6 key areas that seem to be quite urgent to plug the hole in tax revenues. So extractive industries, tobacco and alcohol, taxation of multinational, fixing the VIT. These are not easy to do, but certainly very important to do type of reforms. And here at the OECD, we have seen that even with modest investment, we have a project called Tax Inspector Without Borders that helps undertaking audit of multinational corporations. This can have a tremendous effect. If my memory is right, I think that the project of the Tax Inspector Without Borders helped raising more than 1 billion additional tax revenue in Africa over the few years that this initiative has been in existence. So taxation remain important. There are certain priorities to be tackled. There are also some relatively quick wins that could be undertaken. But as Rose told us, when you look at the experience of the establishment of revenues authorities, of the centralization of the tax system, of the modernization of tax systems, there are also many complexities that remain unsolved, and that have to do also with the nature, with the structural factors of many African economies, issues related to local economy decentralization, the large informal economy and micro and small enterprises, and the challenges that come from trade and regional integration in terms of revenue collection. This brings us probably to the other point that Kunal was mentioning, that in the end, if you want to increase tax compliance, it's all about politics. I mean, it's largely about politics and checks and balances, but it's also about changing behaviors and putting in place effective mechanisms to nudge multinational individuals, and Smith was saying rich individuals especially, to pay and comply with the tax system. This brings me to the message that Marina shared with us, that is about the fiscal contract and the need of looking at the fiscal contract with reference to both private and public goods, and the importance of improving a broader set of frameworks and institutional capacities beyond taxation if we want to unlock the potential of taxation. And she gave a very pertinent example with cadastre and land registration as an important tool to increase property taxation. With all of this, I'm sure that I haven't done justice to the richness of your points. I just wanted to summarize. And before coming to a close, I would like to share a word of thanks. First of all, to our panelists. You have been fantastic, super interesting. Second, to our partners here, United Nations University-WIDER and Manchester University. Thank you, Kunal. Thank you, Antonio, for being such great partners. And also to all those people that work behind the scene that were not on screen here, but made this event possible. On one end, the broad range of researchers and scholars that are participating in the project, but that were not on screen today. And on the other hand, the support technical staff that made this possible, in particular, Eva, Jutta, Ruby, Julia, Laura at the Development Centre that really went the extra mile to make this event possible and a success. I would like to encourage everyone to look at the website of UNU-WIDER, where you can find the whole set of papers related to the fiscal state project. I will also do a little bit of advertisement for our own product. We are about to launch on the 15th of December our revenue statistics in Africa that we produced together with the African Union and ATAF. And before closing the meeting, I would like to ask maybe Kunal and Antonio if you want to say a word of a final word. Kunal, maybe.
Well, thanks very much, Federico. I actually summarized everything so well. Just want to say thanks to everyone who participated in this panel. Nick, Marina, Ewan, Hank, Rose, Antonio, Federico, Alexander, and of course, all of those who actually made this thing happen. As Federico said, we are slowly getting the papers for our project on our website, on our webpage for this project. So maybe they are not all there yet, but they're slowly appearing. We have mixed papers there. UN's paper should be there shortly, and so on, but they're slowly appearing. So within a month or so, almost all the papers should be there. So to keep on looking at our webpage for this project over the next month or so, and you'll see the papers coming in. There are lots of very interesting papers. And as Federico said, not all the papers obviously could not be presented today, but there are quite a remarkable diversity of work that's happening on this very important question of how to develop fiscal states in developing countries. Thanks.
Thank you very much, Kunal. And so this seems to me to be the end of our beautiful 2 hours event. Thank you again. Thank you to all those who watched and participated, and stay tuned, more to come. Goodbye.